As the coronavirus spreads and countries take an enormous economic hit in the fallout, the risk of sovereign credit rating downgrades significantly increases. AM Best specializes in insurance credit ratings and does not rate sovereigns, but it does consider such risk through its country risk analysis. Here to discuss how AM Best handles sovereign credit issues and country risks is Andrea Keenan, Senior Managing Director, Strategy and Communications. Andrea, good to see you.
Hi.
Andrea, can you explain the difference between sovereign credit risk and country risk?
Sovereign credit risk is essentially the willingness and ability of a sovereign government to pay back its debt on its public books. And country risk, on the other hand, is about the operating environment, at least the way we define it. It's about the operating environment of an insurer and what risks are brought to that insurer that are beyond its control and beyond the specialization of an insurance company.
And how does AM Best determine the level of country risk for a specific country?
Well, AM Best measures country risk through a number of empirical factors. We use data from the World Bank, the United Nations, the International Monetary Fund. We look at corruption levels, and we summarize those risks into several categories: political, financial system, and economic risk. And also that includes the risk that is inherent in an insurance regulatory environment. And there is a model that takes those factors, groups them, and comes up with 5 tiers, with 1 being countries with the least amount of risk, and tier 5 being countries with the most amount of risk.
Let's go back to sovereign credit risk. How is that considered in AM Best's rating process?
Well, it's certainly a relevant thing in terms of country risk, because whether or not the government is financially solvent and is able to pay back its debts is relevant to many actors that participate in the economy. If you're holding sovereign debt, that's, whether or not the country is going to pay back its debts is certainly relevant. It's also relevant because there are many private companies that hold sovereign debt, and so their creditworthiness, and often insurers as well, but especially banks, they're going to suffer when the credit risk of a sovereign government goes up. But also it's factored in country risk in that there are a lot of parallels between those things that negatively affect sovereign credit and those things that negatively affect country risk.
Are sovereign ceilings placed on any of AM Best ratings?
Absolutely not. We do not employ ceilings. So in this time where we're starting to see sovereign downgrades by those that rate sovereign credit, our ratings tend to stay stable. We've seen things like this in the past, and there's a volatility that will occur in many of the sectors in an economy, but the insurance sector does not have volatility based purely on the creditworthiness of the sovereign.
Now, some countries could see a sovereign rating change as a result of the COVID-19 virus. If that should happen, would it impact that country's AM Best country risk tier?
It is on a company-by-company basis. We look at every company and we determine whether or not they are subject to a large extent to risk inherent in the sovereign. So if they are holding a massive amount of sovereign bonds, there's going to be an impact. If they're concentrated in one country, then that is going to have an impact. But it's certainly not a one-for-one correlation.
What has AM Best seen in previous credit crises, such as the Eurozone one last decade?
That's an excellent example, and we've seen that there are some companies that were highly exposed to credit risk, especially in Italy, for example, who did experience downgrades, but that again was on a company-by-company basis. We observed that companies were highly subject to the creditworthiness of the sovereign. They were holding an extraordinary amount of sovereign bonds. They were subject to the interest rate changes that followed the sovereign crisis, and in demand changes and other economic slowdown. And in certain specific cases, there were downgrades, but by no means is there a wave of downgrades that comes with a sovereign crisis. It is evaluated on a company-by-company basis, and we get in touch with companies as these crises unfold to determine what they're doing to mitigate certain risks in the economy if that happens. And we stress those companies through use of a stress test. We look at all of those things that are correlated with the sovereign crisis, and we determine whether or not a balance sheet is showing a decline in strength as a result of the decline in the creditworthiness of the sovereign.
Thanks, Andrea.
Thank you.
That was Andrea Keenan, Senior Managing Director, Strategy and Communications for AM Best. And for AM Best TV, I'm John Weber.